content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Andreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. WriteUp. Mini intro write-up on DFM. It's been a while, so let's get a little sneak peek. So, hey everyone. As always, it takes a little bit more time to get back and running once everything's set up. I did get my laptops right here. Very happy with it. There's a few things that are not as expected, but in life, always expect the unexpected and adapt as it is. So I'm really happy to be back. My apologies for being a bit late. I'm also focusing on prioritizing a few different things and seeing how that will develop. On the writing forum, I'm working around 14 to 18 write-ups. Truthfully, half of them might be a little half-assed ideas that still need a little bit development or shall forever be locked up as forever drafts. But I'll try to focus on them, prioritize what I have through, and get through them as soon as possible. For those following or waiting for the MLC update, first of all, wow, what a bloodbath it has been for the past couple months. They recently reported earnings. And to say politely, investors are justifiably not the happiest. And also coupled with all the drama in the private credit fears and market uncertainty, the huge goodwill write-off on their current earnings, you may understand why the stock is down. I recently got to meet some of the management, so huge shout out and thank you to them, who have been the most generous in humoring my time and questions, taking the time and really explaining it to some of the assumptions that I had that were wrong. I've been working on a draft of some of the things that flagged to me and things that might be areas of concern that might grow to our proportion, and my assumptions of how that was growing were wrong. But there, as some questions get answered, more questions come out. So it's going to take a time to just piece my thoughts together and get through it. So full disclosure, I still own the stock. I also do think that I did overestimate my abilities a little bit, and I should have put that in the too hard pile. I know that this has been an enormous educational experience, and I did add a few things in my pilot checklist as growth from this opportunity of what things to watch out for future. So I do think it has been immensely important as an experience. And I do know the notion, as Buffett and Munger say, that you don't need to make money the same way you lost it. But there is some value in the company. I just need to fully understand it. And I do feel that I've made a few connections that are in the process of helping me out. I will try to give him a shout out. I had a discussion with Ben. Ben was wonderful. I had a discussion with a few other notions. I don't know if I can mention their names or not, so I'll keep that up wrap as well. But a few other investors who have looked at the company, who have shared their thoughts and feelings about the company and where it might go. But, that's a story for a different time. So, today, since it's been a while and I feel that I've been serving you from content and from write-ups, I want to introduce an idea, maybe not as in depth, but they did have a different piece, talked about exchange so they can make money, talked about instruments, and I did have a write-up a while ago talking about GPW on the Polish exchange. I didn't go details, but I did mention that I really like the company. I was a little scared that there's got an overship. Of course, there are irony with coming with the company I'm introducing today, but very similar vibes. Today I want to introduce and welcome a very interesting monopolistic company in Dubai, DFM, so Dubai Financial Markets. Let's give me a little history. And yeah, I know the caveat. There's a disclaimer. I may or may not own the stock at any point in time. Please do your own research and advice. As always, disclaimers are all the same. So the Dubai Financial Markets, DFM, was established by the Dubai government decree number 14th in 2000, on March 26, 2000. At that time, it was the first and only stock exchange in the UAE and the only one to operate under Sharia principles. Initially, it was fully owned by the government, but in 2006, with listing in March 2007, it went public via an IPO. That was allegedly oversubscribed 118 times. The IPO floated about 20% of the business. The remaining 80% continues to be held by the government today through the Borsa Dubai Holding Company. In 2009-2010, the business consolidated when DFM acquired a majority ownership stake, 67%, in Nasdaq Dubai, formerly called the IFX. This created a dual exchange structure where DFM served the domestic market and Nasdaq Dubai facilitated international investors and dual listing stocks. Today, it remains one of the largest exchanges in the region, operates alongside notable regional peers such as exchanges in Kuwait, Saudi, and Israel. These are just public exchanges there. There's a very beautiful corporate line on their annual report. So as a side note, I found out that a lot of the Dubai companies have very, we'll call it colorful, plainful, and infographic annual reports. I would recommend just to check it out. Very easy, you can skim it, get a few idea of what's happening. Again, in general, I found that to be a pattern in their listings and companies I find there. So recent news, I think it'll be dishonest to go on without mentioning the current uncertainty and regional conflict. The general markets in the region are obviously down. There's a huge question mark whether this conflict has, broken the, I don't want to call it an illusion, or broken the idea that Dubai is, and the UAE and the other states in the region are the Swiss or Singapore equivalents of the region as they're transitioning away from fossil fuels. Whether that is different remains to be seen, but that is a reality on the ground. This is a fear and a question mark raised about the region. So now for the idea itself. I'm not going to go into details how stock exchanges make money, the history of how they went through. There's a write-up for that, so please check it out on Substack if you're really curious. I go through the different products, how they can make money, what the margins could be. But here we do have two kind of pockets. One is the traditional exchange, so the traditional business, and the second is the asset pocket. So in traditional business, the regular operating vehicle would be exactly as you expect from a stock exchange. This includes trading commissions based on the volume on the exchange, clearing and settlement fees, listing fees, market data fees. So this means that if you want to trade equities, futures, if you want to list or buy or trade bonds or sukuks, apologies if I pronounce that wrong, but that's just Islamic bonds, settle any trades, lend or buy securities, trade carbon credits, or go public via the Arena, aka the private placement platform, you have to go through DFM, with an additional 60% of all fees flowing from Nasdaq Dubai back to DFM. It is a phenomenal business. You are a government-mandated monopoly and essentially are a toll collector for most financial activity in the public markets in Dubai. However, let's not get overexcited in comparing this to international peers because this business is trading at a huge discount to them, but there's valid reasons. So the business itself is quite small, and as I'll go in a minute, everything about this business is about size because unless you have scale, it's not that an attractive business. So the business is quite small. There are not that many investors, as you would see maybe in Hong Kong, Tokyo, or Canada, let alone any of the major players. Of course, Tokyo and Hong Kong are major players. They are, I believe, a total of 23 brokers and 5 market makers in the market. And you look at the marginal of operation, neighboring Kuwait exchange boasts a more capitalized model with higher margins, so they don't have them beat there. The majority of the stock trades is government prioritized projects, concessions, for example, REITs, regional banks, and local oil and airline. Second business, as I said, is kind of the asset pocket. This is where they have their cash. The investment property that they sold last year, that I will say in a minute, liquid securities, bonds, and sukuks. Well, some of this cash and capital is required by regulations and are held for investors. The others is actually owned by them. So if we just break them down by portion, 4.11 billion dirhams, about 6% of the holding is in deposit receipts, and they're parked with UAE institutions carrying interest anywhere from 4 to 5.5% per annum. This includes regulatory capital they're holding for somebody else, so they are earning interest on it. So that is something attractive about the business. Then you have about 1.12 billion again dirhams, or about 18% in equity securities held at fair value. Again, expected drop with the regional conflict and tension in the region. Sukuk's about 0.8 billion, so about 13%, and the rest cash, about I want to say 180 million, and managed funds about 25 million. Also, for those curious, if you just want to calculate tangible book value, just for your own curiosity, 2.88 billion from the Nasdaq purchase, and 1.75 billion in intangible assets. So admittedly, there is some accounting noise, and I did kind of mention they did sell a building last year, and they paid out a massive dividend for that. So they paid a massive dividend of 520 million special dividend, funded largely by the proceeds of the one-off real estate, which was 461.9 million dirhams, which artificially inflated reporting headlines earnings. Because of this, certain financial screeners can be highly misleading because the stock looks artificially cheap at a trailing PE basis. Furthermore, there are some screeners often miscalculating DFM's intrinsic value by treating its entire gross cash balance as available to owners. So while DFM holds substantial liquid assets, roughly about 2 billion of that is restricted cash to unclaimed investor dividends, clearing collateral. But again, DFM does earn some interest on it. However, even if we strip all of that restricted funds, like I said, the true enterprise value remains meaningfully lower than the market capitalization, with a market cap of roughly 11.3 billion dirhams and 2.3 in true unrestricted. Adjusted EV sits at around 9 billion, with a zero net debt on the balance sheet and normalized corporation earnings of last year of 593 million. Again, with the caveat that there could be regional tensions and trading volumes will be lower. The current trading is clean adjusted EV to normalized earning multiple of 15.2. As I mentioned, though, these cash adjusted valuation figures, however, do not fully capture the intrinsic value of the business until you examine its underlying cost structure. So DFM essentially operates as a state-backed regulated toll bridge. Again, a regulated monopoly. In order to access public markets or execute most financial trading, you need to pass through their highway in Dubai, a glowing regional hub of an expanding population. The business is built on significant fixed costs such as servers, routing technology, data centers, and regulatory compliance, and operates with exceptionally low variable costs. Once the core digital infrastructure is online, passing through an incremental trade or facilitating a new IPO, that exchange is the cost of the exchange is particularly nothing. The only remaining issue is the scale and growth of every additional dollar simply flows to the bottom line. There's also a network effect in play. In order for the business to truly be a gem, volume, listing, and trading need to pick up. The more business it attracts, the more likely it is to new listings to come to Dubai, and hence raising new volumes. It's kind of like a snowball effect. So the more you have, the more companies you have listed, the more companies you have headquartered, the more it becomes a business center, the more DFM as a business will actually flourish. And as with using their operating leverage, that's where really the math gets really attractive, and that's how they will increase their margins. So the structure provides, as I said, a huge operating margin. If you look at this dynamic has played out over the last 4 years, the scalability is obvious. If you look at their costs between 2022 and 2025, operating expenses grew by barely 8%, creeping from about 207 million to 224. For the exact same period, operating income has more than doubled, surging from 256, so 257-ish dirhams to 530 million. I do want to remark that there are some regulatory hurdles on the shorts that do not allow the same behaviors in other markets, therefore limiting price discovery, but something very fascinating. So to close, ultimately, this investment thesis is straightforward. You're investing in a regional monopoly tied to the growing Dubai market that has attractive, scalable qualities. The primary downside risk is regional geopolitical uncertainty and any shifts in Dubai's position on the world stage. However, as any student of history knows, people's memories of geopolitical shocks are remarkably short, and global wealth will always demand a secure tax-advantaged hub. Dubai's aggressively pro-business environment has allowed it to continuously capture global market share from traditional financial centers. So, do you think the center is dead? I also want to remark that we, as humans, are not primed to think exponential terms, and the true value of the whole ecosystem is really wonderful at the tails. As a small business, it is not truly remarkable and therefore needs a very long-term view to allow the business to reach scale. However, you enjoy this introduction and keep an eye on this business. There are always some misaligned incentives when the majority of the business is government-owned, but I feel here it's aligned. You have these huge tailwinds that could come to the business, and as it reaches in scale, I do believe it could be produced as a very attractive business. Anyway, hope you enjoyed that. Apologies for being late. Keep an eye on more things, and I hope you enjoy your weekend. Cheers.